Welcome to It Depends, a sales tax podcast by Tax Connects. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. From an agenda perspective, I'll run through this kind of quickly, but we're going to touch very, very lightly on this nexus and taxability portion. We covered these pretty well and went fairly deep and really kind of focus on the other highlighted topics here in terms of sales tax exposure, voluntary disclosures or VDAs. So we'll talk about that a little bit and what the benefits of the VDAs are, where we see them applying in most situations, and just kind of talking through that process of entering and executing those VDAs. A very important aspect if you're trying to get into compliance is what the heck are you supposed to do in terms of actually charging the sales tax? How do you get that sales tax on the invoice? How do you get it calculated and present it within the shopping cart? So we'll spend some time on that piece as well. And then kind of wrap up with a registration filing type of process and share a few thoughts if you're considering outsourcing this type of work. Just share a few thoughts with you in terms of where that might make sense and where we see companies leveraging that type of process. All right, so Jeff, I'll let you talk a little bit about nexus and a little bit about taxability.
Brian's got a lot of handcuffs on me over here. Thank you, Brian. Yeah, I think it's always healthy to kind of just kick off any sales tax discussion with some of these sort of precursors, and that is nexus. Nexus being a connection with a jurisdiction that enables that jurisdiction to impose its taxing authority on a company. And for sales tax purposes, nexus comes in really two flavors. One is physical presence, which, as we talked about in a prior conversation, and can include somewhat permanent aspects of physical presence, an office, employee, inventory, but it also can include temporary aspects, meaning employees or agents visiting a state periodically to solicit. So that's really the long-standing principle of nexus is physical presence. And effective 2018, the next flavor came to be, and that was economic nexus. Economic nexus does have a little bit of uniqueness or variability from state to state, but generally speaking, it's $100,000 in revenue derived from that state based on invoices to customers in that state during a 12-month period. If you've got $100,000 in invoice revenue, it's a good idea to ask the question, did I trigger nexus? Have I met that threshold? Once you've established nexus or determined nexus exists, the next phase in the sales tax arena is determine whether or not you're even providing a taxable product or service in that state. And as I said, there's variability across the states relative to nexus. There's even more variability when it comes to taxability of products and services. All of the states start with the basic premise that sales of tangible personal property at retail are subject to sales tax, and that can be state and local sales tax. And then there are certainly scenarios where services are taxable, and that's become a bigger and bigger component of the taxable base in a lot of states over the last 10 to 15 years, particularly as technology has blossomed as it has. The other challenge around taxability is found in the citusing of transactions. And that can be complicated even in a tangible sale or a sale of tangible personal property, meaning where did title transfer or where did the states deem the sales tax implication to occur? And when you get into services, it's typically premised on the benefit of use. Wherever the benefit of use is achieved or obtained by the customer tends to drive the tax situs for sales tax purposes. But in any case, there's just a lot of basic principles that are made up within the nexus and taxability aspects of sales tax, and that'll lend itself to the rest of the conversation.
All right, so we'll go ahead and segue into the sales tax exposure piece here, Jeff.
Yeah, a lot of the stuff Brian and I encounter with companies we talk with are historical activities, or the business has been active in a certain way in a certain number of states, and they're kind of uncertain. Some cases they really didn't understand that they had triggered nexus, for example, or that their services were subject to tax in other states. So we see all kinds of scenarios that represent prior period exposure or sales tax exposure. And there's a few different methodologies or paths that we recommend. And I'm going to kind of take these a little bit out of order. The one that kind of strikes a lot of our clients and prospects as logical is, hey, I'm just going to go into the system. I'm going to register based on when I triggered nexus, which might have been in June of 2023, and I'm going to start complying prospectively. When you register, the applications, whether they be done online or in paper, are going to ask you, when was your effective date of nexus? When did you start business in the state? That June of 2023 answer is going to trigger compliance requirements back to that period. So you're going to have 2 years basically of filings that are going to be required. And on top of that, you're going to be imposed penalties and interest. So it's quite an undertaking to go that methodology or go that path. The only time we really find clients going down that path is if they've been in business for 2 or 3 months and they really just feel compelled to be upfront and honest about it, and it's not overly invasive to the business by doing it that way. What's more common in our experience is companies that are operating in multiple states. They have triggered nexus and do have taxable sales, but they haven't charged any tax to date, or if they have, it's been minimal. Minimal sales tax has been charged or collected. And in those cases, a lot of times it can be argued that a prospective compliance methodology makes the most sense. And prospective meaning I'm going to register effective today, or let's call it March 1st of 2026, and I'm going to start complying that particular month and going forward. That doesn't do anything with the past. It doesn't mitigate the past. It leaves you exposed in literal perpetuity for all that past experience and exposure. Now, in those scenarios where somebody's been charging a little bit of tax, it's not uncommon for us to still go down that path, but we tell them to catch up and pay all of the tax that's been collected on that first filing. It's absolutely critical that every dollar of tax that you charge a customer on an invoice gets reported and remitted to the jurisdiction. So registration and prospective compliance is probably the most common approach for dealing with prior period risk and exposure. And again, that tends to fall in line with a lot of the companies we work with, which are small to mid-sized businesses that are really trying to focus on growth. They don't have a lot of cash, so it doesn't afford them a great deal of luxury to go back and mitigate the past. Again, we always articulate that there's risk inherent in that approach, but it's a calculated risk. And at the end of the day, the way we phrase this, and we talk to jurisdictions about this as well, the best thing you can do is to get into compliance sooner than later. Voluntary compliance is the baseline of the sales tax across the states. They don't have enough resources to audit everybody. And the sooner you get into compliance, whether it's registration and prospective compliance only or doing something in the past, any of those options are better for the state in the long run and really better for the company. The third scenario that we talk about a lot is voluntary disclosures. And I say we talk about it a lot. We like to outline the voluntary disclosure model and we'll talk a little bit more in depth about that in just a second. But those companies that find themselves in a position where there's a material prior period exposure and there's other consequences or circumstances that exist, they might be candidates for a voluntary disclosure program. And a voluntary disclosure program is really a formal program that virtually all the states have in some form or fashion that allows you to come forward and say, hey, I made a mistake, or I did something erroneous and I've got some prior period exposure and I'd like to come forward and work out a plan to mitigate the past and move forward under a new sort of clean slate. And there are two primary benefits to a VDA, one being penalty abatement. I may say this a couple of different times, but I tend to discount that as a real benefit because it's my opinion and belief and experience that even if you didn't do the VDA and you continue to start to comply prospectively and you had that prior period risk, if you were audited and assessed, there's a strong likelihood that you would get some relief on that penalty, if not entire abatement of that penalty. So that's why I tend not to put a lot of value in the penalty aspect. What's really valuable, though, is what we call the limited look-back period. And what we're saying in that is the state, if you haven't charged and collected the tax, but you have had nexus and you did have taxable sales, the state will look at your period of activity and give you the benefit of a statute of limitations that applies to a normal filer. That typically looks like 36 months or 48 months. Those are most of the standard look back periods, as we call them, or statute of limitation periods for registered taxpayers. And then what they're saying in essence is if you have transactions that you should have taxed 5 years ago, 6 years ago, 7 years ago, we're going to forgive all of that. We're going to let you slide. We're not going to assess you. And we're going to pick up with this prior 3 years or 4 years of activity. You do have to pay the tax. You do have to pay some interest, but you are going to get the relief of the penalty and you are going to get the relief of those older periods.
And Jeff, before you get into further detail on the VDA piece specifically, I wanted to share one, I guess, story and one kind of example of this register and filing prior period returns, where I think you said we don't often engage in this activity. And one of the reasons, just because besides the requirement to file all those back returns and now you're remitting all of that tax that you haven't reported, is the states generally don't have a real good methodology for attaching the payments to the right filing periods. And if you've not experienced this before, it's really bizarre what happens. But you can go in to a state's website and you can file a year, 2 years, whatever that period, a couple years worth of returns, I say fairly easily, as long as you've got all the data, all the information, you can file all those returns. And you can remit the payments at the same time for each one of those as you're filing and as you're going through that process. The problem comes in where the state takes that payment and that cash that you're submitting to them, and they apply it in a, what is it, is it FIFO or?
They apply it to penalties first.
Yeah. So the first payment's going to apply to the first return. Now you file the second return and a payment that you think is applying to the second return, but they're going to apply part of that payment to the penalty and interest of the first return, and anything remaining they're going to apply to the second return, and so on and so forth. And now you've got this scenario where you've got all of these returns that are filed and some of them haven't even been paid. And now you got to work with the jurisdictions to get all these payments applied correctly, get a penalty assessment, an interest assessment, and then pay that separately. So it's just a real administrative nightmare to try to work through that. The VDA process is much easier from that perspective. The other story, and this just happened maybe this week or last week, and I think you're involved in this or getting ready to get involved in this, Jeff, but it was a company that we had talked to, I think 2.5, 3 years ago, and recommended the prospective or registration and prospective compliance. Hey, just get started, do something, stop digging the hole. Well, unfortunately, they ignored our advice, came back fairly recently, within the last few weeks, and now they're engaging us in 8 or 10 VDAs because now they've dug this huge hole, and now they need a way out of it. So now we are doing the VDAs for this company. So just, the perspective of sometimes doing something is better than not doing anything.
Yeah, and that's the thing about sales tax. It's very much reliant upon voluntary compliance. And when we look at, I talked a little bit about the benefits of the VDA, but when we look at a discussion that we have or an analysis that we take on relative to when to do a VDA versus when to just register prospectively, there are a number of elements that come into play or can come into play in that regard. So not the least of which is a scenario where the company is in a position where they expect an equity event within the next 2 to 3 years, meaning they're either going to take on investors or they're going to look at private equity or some type of a equity event along those lines. And what you can expect, and this is very, very true for the last 12, 15 years now, is that due diligence is going to include sales tax. And the PEs are very sensitive to sales tax risk and exposure. A lot of times they're looking to make the investment or make the acquisition with the intent of flipping that business in another 3 to 5 years. And they want no part of any risk that exists in the past. And in a lot of ways, they're just going to brutally force you down the path of doing VDAs. And we talk about VDAs as being a great opportunity and a great option in a lot of cases, and it really is. The fact of the matter is it's not cheap. You've got to pay the tax that's due within that VDA period. And then on top of that, you're going to have some interest. So it's not without some degree of anxiety in trying to budget and decide how to move forward. What's beneficial in terms of a risk quotient is that most of the time we're talking to companies that have this prior risk across 10 to 15 states that are material. And that sounds like a really bad thing, and it is. But in a way, it allows us to put sort of a risk quotient around that, put some parameters around that. And in essence, we say, look, out of those 15 states, what's the likelihood you're going to get audited in more than 2 of them? Probably not very high. So that opportunity or option to forego the VDA and just go prospective with the filings becomes more and more attractive the more and more states you have in that category. But again, a lot of variables, a lot of different scenarios that we like to talk through with companies. They all kind of come together, and we provide our professional experience and recommendation against that. There are 3 states that have been a little bit more sticky and problematic when it comes to doing something prospectively rather than trying to mitigate the past, such that VDAs are a really good plan of action. Those states are Washington and Utah first and foremost. Those 2 states tend to get into your business a little bit more invasively when you go to register and look to try to identify prior period exposure. So we a lot of times default to doing VDAs in those 2 states when there is a somewhat material prior period existence of exposure. The 3rd state that's kind of come around to being a problem is Arizona. And I expect there'll be more and more of these types of states. But Arizona is kind of a wait and see scenario. They wait until you file 6 or 7 or 8 returns, and they go back and look at it. This is what we perceive to be happening within their administration anyway. They go back and look at that 8-month period, and they go, wow, there's a pretty consistent flow of taxable revenue coming into that business that would lead us to believe they probably triggered economic nexus prior to when they registered. And we ought to just ask a question, and maybe there's some pickup we can get if we just pry into that a little bit. So the economic nexus standards really gave the states a little bit more, I think, ability to really drive down that path and evaluate more so than physical presence. But in any case, I probably made it sound more complicated than it really is. I mean, it really can be a real basic question as to whether the VDA versus prospective compliance is the way to go. But we like to go down all the paths and make sure everybody's comfortable when we have those discussions.
Tell us about XYZ letters and how they relate to VDAs and what that process looks like.
Yeah, so an XYZ letter, it's a generic term that seems to have evolved. It's been around as long as I've been around, 35 years or so in the sales tax arena. All it is an affidavit, and it is an affidavit stating that the customer is already complied with or paid the tax liability. So let's say, for example, you've identified that you had Nexus 2 years ago and you invoiced customers and you failed to charge them sales tax. It's possible, if not likely, that some of those customers self-accrued and remitted use tax directly to a state, or they've since been audited by a jurisdiction and they've been assessed and they've paid the tax via the audit. The other scenario potentially is that they have a reason to be exempt, in which case they might provide you with that documentation. But the XYZ letter just represents an affidavit, a statement. It's usually a template that we ask our clients to put on their letterhead, send to their customer, and have their customer review and validate whether or not those transactions have already been taxed. And auditors will accept that as a mitigating factor.
Perfect. All right, so we're going to move into sales tax registrations.
Yeah, so as we talk about the VDA process or the prospective registration and compliance process, it is important to have a little bit of a picture in your mind as to what's going to happen during that registration process. In some cases, people are finding it to be a little more intrusive than they expected. And sometimes it's a little more complicated than you might expect. There are scenarios where you've got to really pay attention to the tax type. Am I selling communications taxes? Am I selling tangible personal property? Those can be two different registrations or two different aspects of compliance within a jurisdiction. The other thing that's prominent in more than a handful of states is what we call home rule jurisdictions. These are cities that exist within a state that have enacted their own sales tax laws and administration. And so they act as a mini state within a state. They have their own taxability rules, sometimes and most of the time following the state rules, but they have their own registration requirements and nexus thresholds. So you've got to be aware whenever you're going into states. These would be states like Colorado. They have about 73 home rule cities. Louisiana and the parishes. Alabama has a number of home rule cities. The city of Chicago, in some transaction types, we would call a home rule city. It's the only one in Illinois, by the way. So it's just important to grasp or have an understanding of your nexus footprint beyond just the states and what you need to be prepared for when you go down that path of registering. We've already touched upon the effective date. That's sort of the magic date that everybody gets a little bit hung up on. I understand the nerves around it. There's a signature that goes on the bottom of these registrations that are basically representing that everything on the application is correct and true to the best of your knowledge. We've seen and been involved with probably 3,000 to 5,000 registrations over the course of Brian and I's career. We have definitely seen scenarios where a company registered prospectively, were subsequently audited, and the state went back further than the registration date and assessed tax and penalty and interest. We've definitely seen that. We've never seen a state come in and pull out that registration form, hold it up as a perjury document. That just doesn't happen. It hasn't happened for what it's worth. The one thing that gets some people a little bit nervous is the fact that you've got to provide at least one officer's social security number on the registration. That's basically so that the state can hold somebody personally liable for any tax that might have been collected by that company and not reported and remitted to the state. These are, in most cases, trust funds. This is money of the state when you collect it from a customer, and your obligation is going to be personal in nature if the company fails to execute and file and pay appropriately. And then the administration of your compliance account, your sales tax account. Generally, this is going to be an online activity. It's almost exclusively online today. And most of the time, it's fairly straightforward in terms of login credentials, administrative privileges. There is a great deal of dual authentication in play now with most of these portals that can give people heartburn and headaches from time to time. But some of these administration account scenarios encompass multiple types of taxes. It can be payroll taxes, corporate income taxes, sales taxes, all can be under one login. And so you have to kind of be aware when you go into a state to start to comply, to register. You may already be registered for another tax type, and what you're really needing to do is to log into that portal for that tax type and add sales tax to it. And so the variability in that regard, it's a challenge even for us sometimes. The states are always evolving and changing their processes, so you just have to navigate that, expect to navigate it.
On the tax type piece, does it really matter if you, on the sales tax side, if you register for sales tax versus seller's use tax?
It can matter. There are a few states where the expectation, there's actually a different return type. And we have experienced some heartburn when the wrong return type is chosen. It can be managed or mitigated, but it's not where you want to be. So to Brian's point, in some cases, you may be operating as a sales tax vendor purely. In other cases, you may be operating as a vendor's retail use tax vendor. And in some cases, you may be both. And you've got to be alert to that and understand it going in.
Is it the primary difference if you're located in state, you're charging and collecting sales tax, and if you're located out of state, you're potentially charging and collecting the seller's use tax?
Exactly. You could say it this way: brick and mortar is sales tax, and internet sales are generally going to be a vendor's use tax.
Generally the same rate, generally the same form.
Yeah.
But like sales tax, it depends on the state.
It depends. That's exactly right.
Got it.
Well.
All right, so I'm going to talk about the tax calculation piece here. And I think about this, you're kind of running down this path of nexus, taxability, exposure, mitigation. At some point, you got to start thinking about, well, how am I going to get that tax on that invoice or charged in the shopping cart? And the sooner you think about this, the sooner you've got this process in place, the better. There's really, I'm going to say three different lenses that I think about here, and there might be more than that in reality. But I look at this on kind of a scale of complexity, meaning a company, one of those lenses, a company that has a very, very small nexus footprint in one state. I think we would all agree that that's less complex than a company that has nexus in every state. So that's one of the lenses that starts to lend itself towards, well, what do we do from a tax calculation perspective? Another lens that kind of layers on top of that is the complexity of the product or service that you're selling. Tangible personal property and charging the right tax or the proper tax on TPP is going to be much easier than charging the right tax on telecommunication services. We all have some type of cell phone, or I don't know how many people have a landline anymore. I just got rid of mine about 1.5 years ago, so it probably dates me. But you've seen those invoices or your bills from your telecom providers. There's a ton of different state, local taxes, regulatory fees. It's just a nightmare. So that's on that end of complexity. And then really the third thing that I think of, or the third lens, is the number of invoices that you're sending out on a monthly basis. Again, a much easier scenario if you're sending out one invoice versus 5,000 invoices. All things being equal, you could have one invoice that might be hundreds of pages long, but generally speaking, more invoices, more complicated. So when you start to look at that and you see that level of complexity, and you've got someone that's operating in a lot of states, they have a fairly complicated product and service mix, and they're sending out a lot of invoices, that's going to dictate, in my opinion, what type of solution that you plug in from a tax calculation perspective. And I've listed out the different options here. There's a lot of the products that you might utilize, whether that's a shopping cart like Shopify or even some of the accounting systems, have some pretty decent built-in capabilities of managing sales tax properly. Shopify has really improved a lot over the last, I would say, several years, with a lot of different categories of different products that you can map your products into to make sure the proper tax is charged. The accounting systems tend to not have as good of a, let's say, a process or knowledge base from a taxability perspective, but certainly have the capability of plugging in the proper tax rates. We see other scenarios where companies will leverage a tax rate subscription. So maybe their product mix is relatively simple. Maybe they are selling tangible personal property, where for all intents and purposes, it's going to be taxable in every jurisdiction. And the requirement for charging tax correctly is really just having the correct tax rate and utilizing a tax rate service, whether that's a table that you upload into your accounting system or have some type of an API interface into that tax rate system. That's an option you can go down as well. And then for those more complex scenarios with the multiple different products and services, lots of states, lots of invoices, you're really going to need some type of sales tax software. And a lot of times we'll just refer to that as a tax engine or a sales tax calculation engine. And what happens with those products, if you're not familiar with them, is that they're going to integrate to the shopping cart or to the invoicing system, and in real time calculate the proper sales tax for you. So you're going to pass, and I say you're going to pass this. This is all a technology function. So you're not physically doing this, but you're going to pass certain data elements from the accounting system or from the shopping cart into that tax engine. You're going to pass what's being sold, where it's being sold, what's the cost associated with that product, and other variables that feed into that tax engine. And that tax engine is going to do two things. It's going to make a taxing decision that says that product is taxable in that jurisdiction, and the rate in that jurisdiction is 8%. Here's how much tax is due, returns the tax to the billing system so that you can put that on the invoice or put that in the shopping cart. So some of the solutions that most of you are probably aware of that fit into that tax engine category are Avalara's Avatax product. Thomson Reuters has OneSource. Wolters Kluwer has SureTax. There's Ciratax, TaxConnect. We have our own product as well. We bundle it with our filing service, and it's TaxC. So there's a lot of different options out there. When you do start looking at those tax engines and implementing them, one of the key factors is whether the tax engine has what I refer to as the content to support the taxability rules that you require. And simple example, we often talk about telecommunication services. This applies to other industries as well. But not all of those tax engines are going to have the content to know how to tax telecom services. Similarly, you might be providing leasing services. Some of those tax engines, again, aren't going to have all the content to support the taxability of leasing content. Food and beverage, that's something that has very specific tax rules associated with it. So you want to make sure that the tax engine supports the content that you need, and also has hopefully built-in integration with the accounting system that you're trying to integrate to. So just a few comments and thoughts there. Another aspect of this is managing exemption certificates and the importance of that aspect and how that ties into the tax engine or into the shopping cart or the billing system. We have a service. There's also software that helps manage the exemption certificate process through the collection, the validation, and the ongoing expiration management associated with those exemption forms. This, again, similar to the tax calculation, sits on a spectrum of easy versus complicated. You know, someone that has a handful of exemptions a month, not a big deal. Someone that's getting hundreds of exemptions a month, they're going to want to have some type of system and specific process around receiving, validating, and making sure those exemptions get applied correctly in the tax calculation portion of the process. So now we've calculated the tax, and you got to figure out the next piece of this is we got to remit the tax. We got to file a return, and we got to pay the jurisdictions. And sometimes we'll talk with companies, and they'll say, geez, this is the easy part, right? Everything's done. You know, we've already figured out the nexus and the taxability, and we've gone through all this mitigation work. We've calculated the tax. Now everything's done, right? And it's just super easy now to file the return. Yes and no, just because there's always changes and there's always nuances associated with filing the return as well. But you definitely need to make sure you've got your arms around where your data is coming from. Most businesses, most companies that we work with do not have a single source of their sales tax data. It's usually coming from a shopping cart. It's coming from an invoicing system. Maybe they're selling on a marketplace, and all this data is coming together and aggregating to be placed on a specific return. So you need to make sure you understand where all of that different data is coming from. The tax calendar is just a reference to where are you currently registered and what's the filing frequency associated with each of those registrations, whether it's monthly or quarterly or annual, semi-annual, bi-monthly. I cover all of them.
I think you got most of them. Quarterly with deposits. Quarterly
with deposits. So, and those change over time. So you might start out with a quarterly filing frequency, and if you're collecting and remitting a lot of tax, the jurisdiction is going to change you to a monthly filer. There's tiers within each state that says if you report this amount of tax, this is your filing frequency. But that's something you have to pay attention to and you have to manage. Even if you're working with a so-called automated solution that has auto-file capabilities, this is something that they're not monitoring for you. So if your filing frequency changes, you've got to tell that automated company, that auto-filer, that your filing frequency changed. And if you fail to do that, that's your fault. And it's your fault that 2 returns, for example, didn't get filed when you're a monthly filer, or excuse me, a quarterly filer that got moved to a monthly. So you got to pay attention to that. There's different payment options, whether it's an ACH credit or debit. Believe it or not, some jurisdictions require a paper return and a paper check. I think that's, again, more on the telecom side of the business, but it's just completely bizarre to me that we cut thousands and thousands of checks every month for clients and have to match it to a paper return, put it in an envelope, apply postage, and send it off. It's crazy. The technology can't support some of those local jurisdictions, but at any rate. Jeff, you talked about some of the local reporting, at least the local registration, just understanding, what those requirements are, whether it's reporting at the state level or with those HRCs or those home rule jurisdictions. Some of the states have tried to make that a little bit easier. Colorado, I think you said, has 73 home rule jurisdictions. They've implemented their SUTS return. I'm not even going to try to say what that stands for, Sales and Use Tax System. Is that what it is?
Yeah, I think it is.
But they've tried to provide a more consolidated opportunity to file the HRCs or those home rule jurisdictions. It's a very cumbersome, challenging return to file. Our typical rule is if you're in 10 or less home rule jurisdictions, it's easier just to file directly with the HRC. But when you start getting more than 10, certainly 15, 20, 30 different home rule jurisdictions, you can file that SUTS return. However, there's always exceptions to the rule. There are some HRCs that if you have use tax to report, you cannot use the SUTS return. You still have to file directly with the HRC. So they're trying to make it better, but generally speaking, I've found when states try to streamline something, it actually makes it more difficult. Notice management, a big piece of this. Again, I'll kind of point out the automated companies that are out there that quote unquote automate sales tax. They're not looking for notices. Those notices are going to get issued in an e-file account. You're possibly, depending on how you've been registered and how your e-file account was set up, you might get an email that says you've got a notice. Again, from a paper perspective, it's shocking how much paper we get for clients where the states will send out a paper notice. But those notices are going to sit with you, not the automated sales tax company that you might be working with. So you got to make sure you're paying attention to that piece of the puzzle.
Except us.
Except us in terms of watching it.
We manage.
Yes, but we're not saying that we're fully automated.
True.
We're a human in the loop process to manage the those edge cases that purely automated companies don't manage. All right, so this is going to be the Tax Connects commercial here before we have the last polling question. Our primary business is sales tax compliance outsourcing. We also do a lot of consulting, advisory work, and that's the portion of the business that Jeff heads up. But the primary business that we're in is providing an ongoing service to help companies manage their sales tax compliance process. And, when we see companies really wanting to leverage our services, a few different scenarios, whether that's a company that has minimal resources, maybe they have minimal tax resources, minimal finance resources that can better be deployed in other areas. That's when they start looking at outsourcing to kind of better align or realign their resources to more value added, higher level activities and kind of outsource that administrative process. We see it happening with turnover. So even large companies that might even have a sales tax person that all they do is file sales tax returns. Maybe they manage an audit here or there. That person leaves the company and now there's a hole, there's a gap. Sometimes it's easier just to outsource that work than to try to hire a person, train them up and get them up to speed with filing those sales tax returns and managing sales tax. Poor audit results are a big factor. A lot of times we get brought into conversations and it's because there was a bad audit, an adverse audit in a particular state. And now that company is worried about, well, I thought I was okay. I had this bad result over here. Do I have risk in other areas? Let's dig into that. Let's take a look at that. Mentioned exemption certificate management as well. That's something it's a real challenge for a lot of companies to try to manage that and validate those certificates. We see that more and more companies are interested in outsourcing that as part of the overall sales tax process as well. So variety of different scenarios that kind of lead to outsourcing be an option. If you or your clients are ever in that scenario, we'd love to have a conversation with you.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.